Hello and good morning, at least good morning here on the Pacific Coast, West Coast of the US. My name is Jason Snyder. I'm the co-host of The Profit Manufacturer, and we have Annette here with us today. Good morning, Annette.
Good morning, Jason. Good morning, everybody that's listening.
Yeah, and so today it's going to be a shorter conversation, a COGS conversation, direct cost conversation. It could go for hours, in fact, but we'll try to keep it within 35 minutes or so and give some valuable information for everybody out there today. So today's topic is going to be mastering COGS and how important it is for manufacturers to be aware, have systems in place to be knowledgeable about their pricing methods. Far too often, in my experience working with clients, there's very little knowledge or intentionality in their pricing methods, which usually comes around what is incorporated into their cost of goods. So we're going to go over some of those top at the let's say at the high end conversationally, and not get too far into the weeds today on these different things. And so
I'll try not to.
yeah, yeah. So the overview, cost of goods has a huge impact on making sure that we're pricing our products correctly. And when I say correctly, for our market, if you have a strategy of a certain pricing level that you're trying to achieve, if you're undermining yourself by not including all of those costs that come into your cost of goods calculation, you're going to be wondering, hey, what's going on? Why don't I have enough cash? An example would be for us, we have a predominantly strong base of e-commerce clients that also do some manufacturing as well. And one of the things that tends to get overlooked is transportation costs or import duties or other things. Those all need to be part of your cost of goods, or as we term it at our firm, direct costs. Because if you don't know what that number is, your pricing is going to be misguided many times. So, Annette, do you have any thoughts or feedback from your perspective as a manufacturing business owner?
Yes, it's often overlooked. Oftentimes we look at the macro costs and not the micro costs. And the micro costs are really some very important levers that we can change to make a difference in the profitability of our business. I also want to refer often to the Profit First method, which we are both certified in, and how it has made a difference in my manufacturing company.
Yeah. And one of those Profit First techniques that we use is having an inventory account or cost of goods account. And then the other thing that we'll do with some clients is if they're growing or expanding, we're going to have an allocation or funds put aside into like an inventory reserve or something like that, so that they can quickly take on new SKUs or product lines that they're looking to get out to their various channels and things.
The first thing I would recommend on that, and I also have a separate cost of goods account, and everything goes in and out of there. That's raw materials and the production of it. And so what you do is you look at 12 years of data and see how much you spent in raw materials and the production of those divided by 12. And you've got kind of a monthly, just a general idea of monthly what you spend. Now, they're highly likely there's some excess there, and you're going to be able to whittle it down. In fact, you could probably be shocked at how much you spend, because I know I was. When you make purchases in February and it's December, you kind of forget what you made. And so when you have the 12 months in front of you and then divide it by 12, and you think, I've spent that much. And particularly if you have subcontractors, you want to make sure that they're included. And the cost of production should include the employees that are making the production, if you have employees. So it can be a very big nut on your profit and loss sheet. And so you want to make sure that but you have to get all your numbers in place first. It's okay. Don't worry. We've all been there. We've all been shocked. Think, what am I doing? I can't believe I've done this. No, don't worry. That's just all part of the learning process. That's just step one.
Right. And to the part about the employees, for employees that are doing two functions, so one is production and maybe another is admin, what we have clients do is do a time study, usually updated on a quarterly basis or even less. We don't get too granular like weekly payrolls and things, but a quarterly basis allows us to allocate a percentage of their expense to the firm, to the business, to production, so that it can be properly accounted for in the production cycle and costing things.
Excellent point. Very good point.
And another, like you were talking about, the looking back over 12 months for our clients that are in like a dropship or some other model where they've got very little information available from their suppliers. And what we see there's sometimes there could be 10 to 20 transactions per day with their supplier, and the supplier doesn't aggregate that. They basically charge their payment method every single order. So it makes it almost impossible for us to go back and do a proper cost of goods allocation and do accrual on that end. So what we do there is do that same method. We look back 12 months and then take a percentage against their gross revenue. And that's our cost of goods average that then we put into that cost of goods account for them to adhere to their proper first system and things. So very quick to approach that.
Yeah.
So next we're going to talk about direct costs versus indirect costs. And I'm going to use a term that we use internally at our firm. And this may not be kosher with your tax person or some other accounting methods, but it's worked really well for our clients to get visibility on what truly is their direct cost for manufacturing and delivering that product to their end user, their customer. And again, because we have a heavy concentration in e-commerce, this comes up quite often as what do I include in my cost of goods? And so we've reframed it as direct costs, and that's inclusive of every component or value add that gets the product to the customer. So for us, that's packaging, that's the shipping cost, inbound, outbound, storage, logistics, if there's any labor involved, all of those are being included in that direct cost. And that's the formula for us when we're preparing our allocations for our proper first systems that we're incorporating into that and then allocating for.
Absolutely. You mentioned shipping and freight. One thing I always, a few years ago, I separated the freight of the shipping in of the raw materials. For instance, in my business, cast covers, it's huge bolts of fabric, and the freight is expensive because it's a heavy thing and it's coming from, Washington State or New York or something like that. And so it's very important to have that separated from the invoice that you receive, because you want to be able to tweak that if you can. And the way you can do that is you negotiate with your vendors. The other thing that's important is the shipping to the customer. And it could be whether it's direct to consumer, or if you're an FBA, shipping it to, sometimes you have no choice because you use the Amazon preferred partner for FBA. But the shipping to the direct consumer, because I have both, I have direct to consumer and then I have B2B, and I consider Amazon a wholesale account, and that can be a whole nother discussion. But the direct to consumer is very important, because I started seeing a very rapid increase in costs in direct to consumer shipping a few years ago. And it was because our methods were not being utilized properly by my team when they were printing the shipping. So you have to have, shipping has to be separated to the consumer and versus freight in of your raw materials. So keep those separate.
Right. And another example is a client of ours had items that was one-off items, big ticket sales, anywhere $10,000 to $20,000, and he needed a flatbed truck to deliver to his customers, and nationwide, selling this nationwide through one of his e-commerce channels, and he was getting, he was losing money because of the shipping costs. And so by going through and doing a review and understanding that when we were reviewing it, that I think it was because his supplier was on the East Coast or pretty close to his East Coast, where he was losing money was his West Coast clientele. And so what he did is we updated it and go through, and any zip code west of a certain area would get a $50 surcharge. And that he's able to recover and then maintain his margins, his gross margins and things. And so those are things that if you're reviewing this consistently and getting your pricing correctly, you're not going to have black holes where you're thinking, hey, my OPEX is too high. Why am I losing money and my net margins are way down? it's almost 80-90% of the time in the work that we've been doing with clients, it's on the gross margin, not on the operating expense side. So that's why it's so important to get this correct.
The other thing you want to look at, particularly like freight in, a lot of times my vendors would add a surcharge to the freight. And that's when I realized that I could use my own freight carrier to pick up the product, and I could save some money that way. So that's something else to consider.
Yeah, and this is a good segue into ways to improve your pricing. You had some experiences that you could share with the
yes. So oftentimes people are afraid to raise their prices, and of course we've had to raise our prices. Everybody, I think, across the board the last year and a half, just because of all the supply chain issues, because they've raised their prices, so we've had to raise our prices. And one thing that so first of all, don't be afraid to raise your prices with your customers. If they truly love your product, they're going to come back and buy it. Now, of course, you can't accelerate it at a eye-popping price, but if you up it 5%, imagine what that would do to your bottom line. And most customers are not even aware of it. Now, my company, Cast Covers, we make fun and functional products for the orthopedic patient. And 87% of our customers don't come back. So if we change our pricing one way or the other, nobody really knows. And so we're in a unique position. But what I recognized when I was looking at my pricing is I had a 15% sale pretty much across the board all the time. I just changed the verbiage. So Thursday could be Throwback Thursday, Friday could be Friday sale, and it was always 15% across the board. And I realized, you know what? I got to drop that. And so I dropped it to 10%, didn't change sales at all. That's because, again, people are coming to our site who are new. And the reason I keep it consistent is purely a grievance filter, because there are times I would do 10% or 12% or 15% or 20%. I used to do that a lot. And customers would come back and say, hey, I got this for 15%. Now you have a 20%. I want that. And so I eliminated that grievance factor, which was hard on my employees, the customer service, and that friction point. So I just kept it across the board the same. So that's kind of if you can do that, keep the pricing the same, but change the messaging. So it's a call to action. Today is Monday, and I think I can't even remember what we have today, but it's consistently 10%, and we just change the messaging. That's it.
And some of the other things that you might be able to employ that we were discussing is leveraging coupons and or rebates. So if your suppliers have either of those programs available, leverage those, track them, be aware of them, ask them. Don't be sitting back passively and expecting them to communicate that to you. Reach out to them and talk to them and see what's available.
Yes, there are many times I go back to like my care tag supplier and ask them, they had a sale maybe 3 months earlier, could I still get that sale? And more often than not, they say yes. It's just the timing for me 3 months earlier was not appropriate in my inventory cycle. And so, because I'm a good customer, though, I'm a good paying customer. I'm consistent, come back, pay my bills. And so they want to make sure that they keep me. So that's also very important in your business is stay in touch with your vendors, pay them on time, and be loyal to them. If they do a good job, be loyal to them.
Yep, and that brings up the next one. Good segue into early payment discounts. So if you've been a good customer and you're keeping in contact with them, the chances, if they have a program like that they'll add you to that. And one of the things I see a lot of in our customers' books and looking at their records is a payment within like 10 days or 10 days before it's due, like a 1%, 2% discount if you pay early or something. And so look for those. Ask your suppliers. It doesn't hurt to ask, even if they don't have something. So if you have a good relationship and you've been paying on time, they're usually more than willing to at least talk with you, whether they have one or not. When they do start one in the future, then you'll be at the top of the list to be able to join that. So
and to add to that is I had a fabric supplier. I received and I'm good sized customer of theirs. And I received an email saying that from this point forward, we're going to be charging 3% for credit card purchases. And I was like, I don't think so. And so I called the owner, and he agreed that I would not get the 3% charge. And so that's something else that you can do is contact. If you find out that they're charging you interest on, a fee is actually what they call it. You want to see if you can be excluded from that, particularly if you've got a good relationship. And so that's another way to save money.
Yep. And it's a good segue into the next one is using non-card payments. Even if you're currently on a card, most businesses factor in the cost of credit card payments if that's part of your financial stack, if you will. And contact them. Is ACH open? ACH has opened up in the last few years as margins have been compressed with the inflationary environment. Many suppliers are re-examining their payment methods and channels and things. And so talk to them. If credit cards or card processing is part of your financial stack, talk to your suppliers about paying them through ACH and then reducing it by 1-2%. And I did want to circle back why the question might come up is why would early payment discounts be valuable for a supplier? So many suppliers, factories, other businesses in general have lines of credit that they operate from. And so the more cash they can get quickly, the more quick they can receive their cash, the less reliant that they need to be on credit lines, like lines of credits and things like that. And so if they can incentivize their customers to pay, the less that they have to rely on those things. And so that's why those work, and something you should explore in your business too. If you've got customers, offering those things can greatly reduce your need for lines of credit and other external sources of capital.
Absolutely. The pricing there are so many levers that you can pull back and forth to make a difference. And hopefully we're giving you a lot of good ideas. The other one that I wanted to mention is looking at whether your product is actually priced properly. And there's a rule of thumb that cost of goods to sell at retail should be 5 times cost of goods. So if you have a product that's $20 cost of goods, of course, then it's retailed for $100. What that gives you is room for wholesale and distributors. Plus it gives you a lot of margin if you sell direct to consumers. And so you take all your costs again, put everything in, the labor, the materials, the notions, the freight, everything again that we're talking about, put it in, and then multiply that by 5, and that should be your retail price. If you're not there, that means you've got some tweaking to do. And so, for example, I'm working with a company that has starting a clothing line, and they're brand new. So they are not going to get 5 times cost of goods just because of quantity. You can just get better pricing at quantity. And so I said, the first year, you're probably not going to make money. And so we've got a formula on how to get there. Of course, sales make a difference, but but as a general rule, once you're an established company and you've got a history of sales and you can buy in a larger quantity, then you got to look at 5 times cost of goods. And it's also a fun way to look at, if you're looking at your competition, you can reverse engineer. Oh, they're selling it for this, divide that by 5. Wow, I know what their labor and materials costs are. And that's a general rule of thumb. I wouldn't, I would use it as a good thumbnail as research into your competitors.
Right. And the next part we want to go over is the different methods on accounting methods and inventory costing methods, and how that definitely impacts how we calculate cost of goods or direct costs, as I've been referring to it. So quick primer, I'm going to start with the basics, cash versus accrual. Cash basis accounting, it's basically when you receive and spend money, the transaction gets recorded on your books. I'm going to assume most of our audience is going to be on the accrual side, but it is useful to understand the cash side, cash basis, and it's basic would probably be the best way to describe it. It's just recording transactions when the cash impacts your business and things. And most of businesses that are below the 10 million in gross revenue range are going to be a cash basis accounting for their tax purposes, but operate their business on accrual books and things. And the I'll say the downside for cash, even though it sounds simple, is you don't have a lot of clarity of what's going on in your business. We need to know when we're incurring future expense or when we're receiving revenue at some point in the future. We want to be aware of that so that we can see what's going on. So you have a lot less clarity with a cash basis accounting method than you do with an accrual basis. Next is the accrual side. It's basically the excuse me. It's whenever an action results in earnings or accrues an expense. It's kind of the textbook 101 version of what it is. And this gives you a lot more clarity on what's going on with your business, like I was talking about earlier. And all of our accounting systems, the Xeros, the QuickBooks, are going to be primarily set up to deliver an accrual set of books and things. And it gives you a much clearer picture. And for our purposes, it helps us to get clear on our pricing and our cost of goods and what's going on with our business. Also, tracking our assets, liabilities, and then additionally, there's the compliance side. Most all of our reporting methods, so your banking, your other outside third parties are going to want to be able to see things in GAAP, which is what accrual operates as well. Okay, so that's kind of a quick primer on that. Any thoughts from your perspective on how?
Yes, actually, the Profit First method, which we're both certified in, is a cash flow management program versus the accounting standards. So our purpose is to give you clarity in the cash flow, because quite often we look at our P&L and say, well, where'd the money go? And this, the Profit First method gives business owners a really clear picture, because we look at things very differently than accounting. This is not changing your tax forms at all. You know, the accountant still does what they're supposed to do and follow those rules. This is the Profit First method allows us to get a much better handle on our business and be able to make some decisions that will give us the clarity we need to make good business decisions. And I know it transformed my business without a doubt, many times.
Right.
Many times.
And then the other thing is how it affects inventory, cash versus accrual as well. Same applies with the assets and liabilities, the discussion earlier.
Yes.
Then,
sorry, go ahead.
I was just going to say, we can talk about the inventory costing methods, but you had something to add there?
No, the only thing I wanted to mention about inventory, and we've talked about this before in another episode, is you've got to look at your inventory. There's a potential price savings for you right there if all of a sudden some inventory is missing. So you really have to keep your eye on it. And if we're talking about mastering COGS, one of them is really knowing where your inventory is, whether it's in-house or it's at subcontractors, where it is, how much you have, what are the yields, no matter what you're making. And you have to have a really good handle on your inventory, because there can be waste and there can be loss. And so it's very important to stay on top of that. Very important, because all of a sudden, I know I had a inventory issue where I knew I had a couple hundred yards of one fabric, and it happened to be at my supplier. And I said, you gave me an inventory sheet and you don't have this. And yes, it's there. It took them about 3 days to find it. But in their system, it was gone. And in my system, it was there. And so, but we found it, and they sent me a picture of it, and we have it, and it's good. But that's an example. You stay on top of it, because all of a sudden something could get missed. Other people are touching your data, and before you know it, so you stay on top of your inventory.
Yep. And we did have an episode previously with Sharon Custer. I don't remember the episode where we dived into inventory costing and why it's so important to be, I want to say hyper aware, but to have a strong system to be able to manage and understand what's going on with your inventory. And then I guess I don't want to say fun part, but the different inventory costing methods of our LIFO, FIFO, weighted average, and then you introduced I want to say new one. You recollected it, let's put it that way, the
LILO, which is just in time.
Yeah, just in time methodology. And then for those terms, the LIFO is last in, first out. So basically taking the last in the first out. So we're costing out, putting into cost of goods when those items are removed from inventory, hopefully through sales. First in, first out, FIFO, and then weighted average, which is the most common for most of our clients to be utilizing. It's less burdensome on the, say, record keeping and systems and processes you need. You definitely need strong systems for the weighted average as well, but it's less intense and there can be less rigor applied in maintaining a weighted average system versus the LIFO, FIFO methods. Do you have a preferred method in it that you've been using?
Typically it's first in, first out. But one thing I did want to point out is when you're doing the inventory cost averaging. So I got really, when I was a newbie manufacturer, I got really bent on how do I do this, because my black fabric was different price than my printed fabric. Printed fabric is more expensive, but I was selling a lot more black. And black still continues to be our number one color. And so do I price it based on black, or do I price it based on print? Do I do this? And do I have this? What about this size? This size is a bigger seller. I mean, I really got into the weeds, and I was very concerned I wasn't getting the right pricing. So my CPA and I, which of course, be friends with your CPA and your bookkeeper, we went through the exercise of a few items with the different fabrics, the different sizes, and saw it was basically over time a 7 cents a unit difference, which was nothing in my business. And so the average is fine. Do I recalculate this every 2 years? Oh yes. In fact, I do it every year now, just because everything's changing so rapidly. I just make sure that I'm still within, so the average of inventory pricing is critical. It really is. And just talk to your CPA about it. Doesn't matter if you're tooling, tool and die. Doesn't matter if you're making Murphy beds. It doesn't matter what you're, because this wood is different than this wood in this Murphy bed. I had that discussion with somebody. And if it's close enough, and your CPA is happy, that's the important thing.
And the other thing I'd say about inventory costing methods is be consistent.
Yes.
In how you're doing it. It's actually more important to be consistent in your record keeping and how you're approaching it than random, because it'll mislead you, especially when you're doing forecasting and other things, when you're using historical data and trying to come up with forecasts for the future if that data is not collected and then processed in a consistent manner. Because and the other thing is, if you're shifting how you're recording, like let's say you're doing inventory counts once a quarter, and then you shift to once a month or vice versa. And you don't then go back and have at least a note in your records or your books of like, hey, we shifted to a quarterly or a monthly system after being quarterly on this date going forward. Those are important things to reference, because in the future, you're not going to likely remember 2 years down the road when you're referencing that data to build projections and other forecasts that you made a shift there. And that's one that would likely have a less impact on things, but there's other things that would have even a bigger impact. One would be, for example, shifting your shipping costs from the OPEX up to the cost of goods. You definitely want to reference that, or even go back 1 or 2 years and try to shift that back into your direct costs, so that your forecast, when you're leveraging that historical information for projections, that's accounted for and at least aware of when you're reviewing those numbers and comparing those numbers.
Two points there. Number one, the data is only as good as it's inputted. So, for example, you want to make sure you've got somebody, and particularly in the first creation of your inventory system, worksheet, whatever it is, you want to make sure, because if it's $30.29 and it's supposed to be $30.89, that makes a difference. And so you got to make sure the data in is correct, number one. And then number two, the consistency. I completely agree with Jason, because I was audited by the IRS. And by the way, I got a NC, which is the best you could ever get, which means no change. Yay. And it's because I was very consistent, very consistent. Was I rattled by the IRS audit? Yes, I was, because who doesn't get rattled? And but luckily my CPA, who handled it for me, but she's been handling my book, so she was very clear on everything. But it was a process, and the information we had to provide. So the consistency and the accuracy is important if and when, God forbid, you get audited by the IRS. It does happen. It does. And she said she's never seen an audit come back as NC. No change.
Yep. And I've seen a couple of those as well. And you were correct. The record keeping, the consistency was the determining factor, where most of the time the auditor's like, hey, there's not much here to see after going through their process. They still have some process they have to go through. But most of the time when it's really clear, it's either super small or like you experienced a no change.
And so, Jason, we should have another episode just on IRS audits and just some of the silly things that they ask for.
Yeah.
I'll give one hint. They ask for the contract I have with my e-commerce platform. There is no such thing as a contract. You just pay every month. And they did not understand that. They didn't get it. And this is a while ago when e-commerce, it's only 5-6 years ago. And so you think they would, anyway, do I have stories?
Yeah.
Do I?
Yeah, that would definitely take up an entire episode.
Oh, yes.
So we've covered an overview of cost of goods / direct costs, as I'll refer to it. Anything else in it that we should?
I'm just looking at. I'm looking at our notes from our earlier conversation, going over this broadcast. Packaging. I just want to go back to packaging. Jason highlighted it early in the conversation, and a traditional COGS model. For manufacturers, you don't include packaging. You just include the materials and the labor. However, if you're selling direct to consumer, the important thing is you got to include the packaging, because if you're selling direct to consumer, it goes out in a package. I'm not talking about the shipping envelope or the shipping box. I'm talking about the actual product, or for example, Amazon FBA. You can choose to have Amazon package it for you, but I would never recommend that, by the way. And that's a whole nother conversation. But you ship your product in bulk with your own packaging, so that has to be included. And in my case, I also have medical supply stores and orthopedic clinics, and they also have to receive the packaging. So the packaging is very important, and that includes the little 30-up barcode labels. It includes the stickers that show the size, and any kind of stickers, any kind of rack cards, any kind of promotional materials that's included in the packaging, whether it's a hang retail hang card, it doesn't matter what it is, it has to be included. And this is particularly important if you have a source that goes directly to the consumer.
Yeah, definitely. And like I was listing many of those expenses that many other businesses have put into the operating expense area. Again, we're separating the tax versus management books here. We're going to articulate that all of those need to be part of your direct costs so that you can price your products appropriately, because those are costs that are incurred before you even get a product to be able to sell.
Right.
That's available.
Exactly right.
So, well, anything else?
I think I'm pretty good. I think the key is efficiency equals profitability. That when it comes to pricing, and a lot of people don't think this is very sexy or fun. Well, actually, it kind of is, because you kind of get to know your stuff and you get a real close relationship with your product, and isn't that what it's all about? And then when you have a really good handle on your pricing, you know what you can do. You know what kind of coupons or discounts, or you can do some larger sales to get rid of certain merchandise. So if you've got a good handle on your pricing, if you have a very good handle on your pricing, you've got a good base to make quality decisions for your business moving forward.
Right. Yeah. And the other thing, being aware of your numbers allows you to, if you have to make quick decisions, that they're more likely to be not detrimental or have some other long-term effects.
Excellent.
Long-term effects.
Yep. Yeah. So you're not desperate.
Yep.
Yeah. Yeah, and desperation usually means a bad decision.
Yeah.
Anytime. It's really a good one.
Yeah. So I think we've covered everything for today. And like Annette was talking about, our expertise is being able to take that and put these systems together and then marry it with Profit First so that you've got the cash side covered. These are all accounting, bookkeeping methodologies that support building a Profit First type of a system so that you can remain profitable, have awareness of where your numbers are, and be able to focus on your business and not have to worry about the numbers and the cash flow cycle. So,
Good summation. Very good.
well,
All right.
that will end up today's call, and look forward to next week. I think you'll be traveling, so I'll be flying solo on next week's call and discussion. So
Okay.
until then, we'll talk to you all next week.
Okay, thanks.
Bye, everyone.
Bye, everybody.